So hi everyone, and welcome to our bi-weekly webinar. Today we have an exciting topic. We're going to be going over the economic outlook for real estate. And we're going to throw in some real assets in there in between. And for those that are new or watching us on YouTube, Dr. Fasanya. I'm a pulmonary critical care physician, and I started investing in real assets since my undergraduate years, which is like 2008, 2009. Over time, I invested in multiple different asset classes, including self-storages, multifamily, office warehouses, and luxury senior living. We also done a few oil and gas deals in the past. However, everything got more interesting in 2018 when I bought my first 8 units. And since that time, I've accumulated over 62 units of my own personal properties and also 1,043 units as a syndication. And that's about to add another 405 units with a new deal that George and I and Disrupt Equity are raising money for right now. So I like the diversification aspect. I like to be diversified. So that's why we go for multiple asset classes. There's an argument to be made for you going all in on one particular asset classes and you became the best in it, or you diversify your portfolio and partner with best-in-class operator, and that's the route that we took. I'm going to pass it on to George. And this is George's favorite topic, so he's going to be leading this topic. So on to you.
All right. Thank you. All right, guys. Good evening. George Ozoude here, Houston, Texas-based orthopedic surgeon in private practice. About 2.5 years into private practice. I was a employed practice with UT for 7, almost 8 years. Prior to this, started my own solo private practice, direct cash pay, no insurances. About to start my own lifestyle functional medicine service line as well. I never thought I'd be a big entrepreneur like this. I actually thought I'd always be an academic surgeon and working with young minds in that very structured setting. But really got to a point about 3-4 years into my employed practice where I saw the writing on the wall, where I wasn't really being able to take care of my patients the way I thought I would be. There was a lot of middlemen in between, particularly insurance companies and hospital systems. And I quickly pivoted and said, I need alternate sources of income, passive streams, and started investing in real assets since 2016. And I've invested across medical office building, a lot of multifamily, both value add acquisitions of existing buildings or development ground up deals. I've invested in agriculture land, citrus farmland. I've invested in mineral rights, which is a kind of an energy, oil and gas type of investment. All in all, I've invested in over 25 deals as a limited partner passive investor since that time. And I've gone on to start my own syndication company, and I've invested in 4 deals as a general partner, mounting about of 900 doors, 900 plus doors, about 75 million in assets acquired. And really happy with the process and the progress and the learning that I've undergone over these last few years, trying to help other physicians who I know are feeling the same friction points of the medical economic landscape. And so a lot of education. We host these webinars bi-weekly. We're really proud of it. It's going on 2 years soon. We're partnering, we're doing deals, and we're bringing value to the physician community. So really excited at this time of the economic cycle to talk about the macroeconomic trends tonight, because we have been waiting for this moment for about 2 years. That's when the Fed started raising rates. That's when things really took a downturn in many asset classes, including multifamily. And we knew it was a cycle. We knew once this little headwind was over, you're going to flesh out a lot of the poor operators or even the bad actors from the space. Deals were going to become going on discount, and it was going to represent a really big buying opportunity and wealth generating opportunities. Watching the macro trends is super important. That's how we're able to foresee this coming and take advantage of the opportunities that we now have in front of us. So I'm going to share screen and go over just a little overview of all the things that you can look at. This is not an exhaustive list by any means, but it's a lot of the things that we look at. And we'll touch on different points of these tonight. We may not get through all of them, but, and I honestly, I want this to be more of a question and answer. We want to hear from you guys, what you guys are worried about, what you guys are concerned about, what are you guys hopeful about as it relates to these macroeconomic trends? Is it something that you guys think about? Could we spark a little seed, spark a little thing in your mind and plant a little seed in your head about paying attention to these things a little bit more as you go on your investing journey, right? Yeah, many things. We could talk about inflation as it impacts investing. We could talk about recession, interest rates, population migration, jobs migration, the crisis with single family homes, the affordability and the access to it, the impacts of supply and demand across many different assets, but particularly across apartment living. Real assets as a broad topic in general, like Bio said, he's in self-storage, senior living, oil and gas. All of these things are real assets. Businesses, he is invested in many businesses as well. And that's impacted by these macroeconomic trends. These are real tangible assets, and they become really important as macroeconomic volatility goes up. And we're in an election year, not just in the US, but it's actually a global election. There's multiple elections that are happening across the globes in many key countries throughout the world. And I don't claim to be an expert in any of those, so that's not my ministry, but I know election turnover and political turnover is usually times of changing policy, and that can impact many things, including geopolitics. We obviously know that's a hot topic right now in many different parts of the world. And I even think healthcare economics we need to be paying attention to. It's been a learning process for me, understanding like how the money works within just our own sector and how that impacts our investing thesis and our investing journeys. So let's get into it. Does anyone have any questions, burning questions, just to start out that they're concerned about? What are people concerned about? Put it in the chat. Or
someone posted, not 100% related, about if I'm a GP in a syndication, can I take advantage of those depreciation losses against my K1 income? I can take it.
Yeah, go for it.
Yeah, so it's not about whether you're a GP or not. It has no more to do with whether you're a real estate professional. So which means you have to spend significant amount of time, 750 hours, doing real estate in a year. And it has to be a major part of your income. So as physicians, it's very difficult in general to use it against active income. However, if you have another passive income from real estate, so it should work against it. So let's say you exiting a syndication and you make 100K, you're entering another syndication and you have 100K loss, you can use it against that. Or you sold your own property, you bought a personal property, you sell it. Obviously, I'm going to also say consult, because our CPA is going to be mad if we don't give you disclaimer that we're not tax professionals or lawyers. You have to consult your professionals. But this is just how I understand it.
Yeah, I understand it the same way too. I think when you say K1 income, you're talking about all your LP deals if you're LP in different syndications. And those are passive income. And so any depreciation losses has to go like for right, unless you have the rep status, then you can start mix and matching that. But again, consult your professional. When you're a GP, that's an active role. We feel like whenever you're a GP, you also invest as an LP. Every time I'm a GP, I'm also invested as an LP. So I have two actual investments. And so I'll get LP income from a K1 from that. I also get the K1 from the GP side, but it's for passive depreciation for passive losses, or passive income, passive losses for passive income. Okay. All right. So this chart, so Bio, man, what have you seen? Bio's in Arkansas. I don't know if he said that, based in Fort Smith. I'm based in Houston. Bio, I'm curious what you've seen in your market, Northwest Arkansas. Very big market, growth market over there. But sleeper, but not so much a sleeper market. This chart itself shows the trends of developers who build multifamily houses. So, Bio, what have you seen in Arkansas, or in even other markets? But
Yeah, this graph, I feel like it's accurate because also based on what I've been seeing as a operator, the amount of other operators that reach out that I'm doing construction, because they reach out to us almost every other day that, do you want to raise money for us? Do you want to do, we're doing this deal, do you want to take a look at it? I would say right about that 2020, yes, there was a lot, right? And then they got all affected by COVID, mainly due to finding labor. It was main issue at the time. Everybody's sick and there's less construction at the time. But
yeah,
then everybody, after the recovery, there's a lot of money in the market. Everybody, the interest rate is low. So of course, then we started getting a lot more construction everywhere, every angle, every place. And then, of course, they started raising the interest rate. And then we started seeing the drop again in construction. I would say it's not completely halted. We're still getting some construction, especially in Northwest Arkansas. In fact, there's other few deals that like last week.
yeah,
So I think people might actually be settling down to the idea of the new normal and projecting that the project that is starting today is not going to be done for 2 more years. So it's going to be done 2026, usually maybe 2027. So they're
right.
projecting that if we start now, perhaps the interest rate will be better by then, and we'll be able to refinance into a better loan. So I think it's starting to maybe stabilize or starting to pick up slowly again. So that's what I'm seeing this area.
I can say in Houston, they make a joke like in Texas, like the state bird is a crane, like a construction crane. And that's because if you look up in the sky in Houston or in any of these major cities, you can see like a crane up in the air building something, building a office building or a multifamily building. There's just cranes everywhere. And I really noticed that when I moved back to Houston in January or excuse me, in of 2013. That's when interest rates were low. And they've been low up until probably like 2018, 2019. And then we saw COVID happen. And then it dropped off. Like literally the interest rates dropped. And I think this chart reflects all of that. It shows that the builds, the new starts, the developments in places like Houston, they responded to COVID, obviously by stopping. But as soon as the rates dropped and the COVID pandemic lockdowns cleared up, they started building like crazy again. So they really built over 20, 21, 22. They got to their peak at 22. And then something happened at 22. You got to ask yourself, what happens in these transitions? They printed so much money to assist the economy to come out of that huge drop off in activity across multiple sectors, that the forecasters, the developers, these are smart people. They saw that the inflation was also going to hit everyone as well. And if inflation hits, the Federal Reserve is going to respond by raising interest rates. And that's what happened. They saw at this time that there was no way inflation was not going to be high in the next few years because there's a lag effect. It takes a little time for the money that's printed to get into the economy. So they saw that coming. And when interest rates go high, the cost to build goes up. They actually have cost on labor, cost on supplies. There was supply shocks from the COVID because a lot of industries slowed down. So it really became expensive to build apartment buildings. And also the money that you needed to raise also became expensive. That consider the dollar as also a supply, like a product. And it costs money to actually get dollars in order to build these apartments. And the cost of money is the interest rates. When that all went up and they forecasted that, they just stopped building. You see here this huge drop off up until this year, still potentially dropping. Like Bio said, they're still building, but it takes a while for them to catch up. And what we have seen is that there's been an increase in supply that came from this run up over the last few months, because that's the lag effect. 2021, 22. Now we're seeing some of those supplies come online. But after that, these next 3 years, like Bio said, there's going to be a drop in the supply because they stopped building after 2022. And this has a major impact on the supply demand dynamics of multifamily. If you have a low supply, you're going to get an increase by nature, you're going to have an increased demand, and therefore the prices of those products are going to go up. So we feel very bullish based on this chart, meaning we feel multifamily investing is going to be very promising over the next 3 to 4 years, because there's just not going to be enough supply, especially in growth markets, Houston, Northwest Arkansas, Dallas, Austin, Sunbelt states, and cities in the Sunbelt states. So this chart, I think, is one of the most important charts. There's no other way you can look at it differently. It's truly a supply and demand thing. And many things just come down to supply and demand, and there's simply not going to be enough apartment buildings for people moving to these very popular Sunbelt areas.
Yeah. And you just have to survive the next 2 years of the, I'm going to talk about that, like what happens to the rent. We can go over that. So what's going to happen to rental market itself in the next 2 years versus 3 years time, right? So all those supply are hitting the market, 2 years lag, right? That peak of 2022 is coming in to road. It's coming to roost this year, next year.
Early next year.
They're already stuck in the construction, so they're going to have to complete to win on this. They're completing that construction, and then it's going to flood the market, and then there'll be a drop off, and then we'll, so any deal now, got to make sure they have a lot of reserve for the next 2 years, and be ready for possible no distribution. I mean, as a worst case, bad, one of the worst case, and then regardless, still exit the deal because of the ability to sell or raise rent significantly in 3 to 5 years. So of course, it's you have to basically just estimate and make your educated guess on these situations.
Right. Yeah, I totally agree. I see some comments about this. If interest rates go up and if the lending bank runs into trouble, what happens? And on that same note, if labor and material costs go up, would it not affect completion of the project? Absolutely. You've seen some projects literally have to stop building because they've run out of money. And yeah, if they're carrying, it's called the carrying cost. Every month they still have to pay for the cost of the money, right? Which is the interest rate. And that went up on a lot of these construction loans. Back here in 2020, when rates were almost zero from the Fed, those interest loans or those loans were costing maybe 3% for the construction loan. And then when the rates went up, they cost like 9%, 10%. And that affected their ability to complete the projects. Yeah, you're going to see different scenarios. You're going to see buildings that literally just stop. They started breaking ground and vertically, and then they stopped. There's one big one in Houston, actually, right now. It's 33 stories, and that hasn't been touched in 2 years. Or you're going to see, Bio said, the ones that are completed, they barely got past the finish line. They don't have any more money left to even lease it up. They've just finished building it, but now they're trying to sell it at a discount because they don't have enough money to hold it through a lease up period. And if it's a 200 unit apartment building, that can take good 6 to 9 months for it to lease up towards stability, maybe even a year, would you say, Bio, for it to lease up to stability. And so I'm looking at deals right now. I'm looking at one in Conroe that's 72 units, and they just finished building. They got something called their certificate of occupancy, and they're trying to sell that deal right now. They're not trying to lease it up. They are leasing it up, but they would rather get rid of the deal right now because I know they're losing money every month because their interest rates are up. And so now you might be able to get this property at a considerable discount and then finish out the lease up process because now you're bringing in a new injection of capital into the deal. You do have to watch your interest rates, but at least you're potentially looking at a next few months to years of lower interest rates if the rates go down by the Fed, right? Yeah. There's anything on that, Bio?
Yeah, I'm going to add to that. So many of these loans are bridge loans or variable rates. And I'm actually seeing better loans now in which when you want to start a construction, you actually fix it. That also has its own disadvantage because if the rates goes down, it might be tough for you to refinance until you finish the construction. So you might be locked in a higher rate. So, but either way, because it's 3%, they keep going up, now you're paying 9%. And then only when you can finish the construction, you can now lock the rate, or refinance into some other loan. So that kind of is very disadvantageous in this kind of high interest rate. I have an example actually. Watercolor. I just remember watercolor was actually done. There's a builder was building it. That's one of our 376 units in Northwest Arkansas. So the guy built like about 200 and something units already, but then he couldn't finish the rest. So the Elevate team and our team actually end up buying it from the builder while he still completes the construction.
Right.
While we now take over the operations.
Right.
And
The lease
same
up.
thing, it was also at a little bit of a discount. And we also, so it's going to happen.
So you can look at it as two sides of the coin. Either you're part of the investment group that started the deal, or you're the investment group that'll come in and quote unquote rescue it, right? Yes, for that group, the initial group, it's going to be headwind, right? Potential lower returns or even loss of capital. For the new group coming in, that's the opportunity. That's what we talked about in the beginning. This represents opportunity. Anytime you get this dislocation of just rapid interest rate hike, there's going to be some opportunity somewhere, right? And you're either on one side of the coin or the other, right? So good question.
For what I'm going to also add, like I know a builder in town who said he has like a margin of like maybe 40%. So sometimes you might just wipe your profit off in some of this. So he has a good margin on the construction normally, but then of course he has to end up wiping off his margin essentially. And he was still able to make his investors just wool, or maybe just returning their money.
Right.
Or just a little bit of, after 3 years, give them like 12% or something. But so it's not going to be all of them that lose money, but there's a potential to do.
Same here. Also, cost of living has gone up. McDonald's meal is $15 to $20. How can they afford rent? Yes, this goes to Maslow's hierarchy. So you start looking at what people will absolutely pay for. You know what I mean? They'll pay for, they need housing, they need food, they need energy to be able to transport, so gas, they need medical. Did I miss anything? Those are like the basic needs. Yep.
Yeah.
And so, what you'll see is they won't be able to afford rent, or they won't be able to afford a lot of these things, and there will be downward pressure on those assets over the next few years. Then when the supply really gets high and the prices get low enough, there's just going to be, when the supply drops off and the demand outpaces the supply, then it's going to actually boost the rent growth up. So you will see a period where it falls off, but it's always multiple forces pulling either direction. It's just which one will gain more momentum versus the other. But yes, people will start to see stress trying to make rent, and that's already happening. I've heard there's even buy now, pay later programs and platforms out there that are floating the rent payments for tenants and then allowing them to pay like on a biweekly schedule, pay them back, the platform back on a biweekly schedule. So that's happening, and that's going to impact. But that also impacts their ability to save for a house or a home or a single family home. And so this puts pressure on them to continue being renters. They may just have to go down a rental class. So instead of a class, okay, go for it, Bio. Yep.
No, sorry to interrupt. Yeah.
No, perfect.
Yeah, basically you have class A, right? So all the people that are having all this luxury apartment living, they're gonna be like, okay, I think I can manage the class B. I don't need a pool. I don't need a golf simulator. So I don't need the Tesla charger. So they move down. and then the B people move down to C. So everybody find themselves at the C class. So that's what's going to happen. People move to the suburb from the big city where it's more expensive. So everybody just figure a way out. But you can get roommates, but at the end of the day, though, you still need a place to live. It's one of those things.
You have to have a roof. And if anyone, it might sound self-explanatory, but just in case, if anyone doesn't know what the different classes of multifamily are, then just let us know, leave it in the chat. But basically, you have A class, which is brand new apartment buildings, and B class, which is mid-level, and C class, which is more workforce housing. And so you do see a shift, right? And that's what we take advantage of. We can buy in a certain asset classes knowing that we're going to get a shift down into that class that'll still support it.
Yep.
Any chance of changes to migration patterns that might affect demand in Sunbelt states and major cities? Yeah, this is a great macro question. I think anything can happen, that's for sure. But what the trend is showing is that the cost of living in coastal cities are increasing with inflation. And regulation is impacting the jobs that usually exist, the big employers that usually exist in those states. And so not only are the people moving, but the jobs, the economic migration is actually moving as well. And so that pattern points to the large employers moving towards the Sun Belt. And that I don't think that changes as quickly as an individual person can move. I don't know if there'll be a flight back to the coast for the economic employers, right? Usually the people will follow the jobs. That is very typical. That's something that we always look at. And the jobs are coming in. They're buying large pieces of property. They're buying acres for new headquarters and production sites and manufacturing sites. So could it change? Yes, but the trend looks like it's going to stay pretty positive towards Sunbelt cities and other major cities like where you are, Chris, in Ohio. A lot of semiconductor companies are looking at Ohio, Columbus in particular. So there's going to be a lot of economic growth there. And I don't think that changes quickly. It's like a big boat. You can't like just turn it around and go back to the other state or the other city.
Yeah, I agree with that. Sunbelt remains strong, and every single, because we look at articles, watch videos, books, everything for this, and Sunbelt continue to show up as to be consistent growth over time. Also, the Sunbelt did not rise, like the prices did not triple. The prices of homes, rent, they all went up, but they didn't go up. Some California or bigger other cities where they went up like from 2,000 to 6,000, or price of homes like doubled. So it has been consistent growth, which is more sustainable than those kind of growth where you have to correct. There need to be a correction when the prices go too fast.
Yeah. I think maybe policy might affect that. And that's where you have to look at the election year and politics and the trends. Maybe that would be a big enough factor to change like what Bio just described. If there's just a sweeping policy, rent control, aggressive rent control in Sunbelt cities or something like along those lines, maybe that might impact it. But then you have to just decide whether you think that's a higher risk of happening versus a lower risk of that happening.
Yep.
Okay. Let's move on to some more charts. All right, hot housing markets. This one, I like this just because some of this is a nice surprise to me. I was expecting a lot of the Sun Belt to show up here. But I think it's good to know what the trends say. Chris, Ohio, stand up. Look, yeah, we definitely knew about the coastal Carolinas, Georgia, North Carolina, like Charlotte, Raleigh. I think Savannah's in South Carolina. We definitely know about Florida. That's getting into the Sun Belt, right? Both coasts, Gulf Coast is.
I'm surprised about
That's very surprised about the Northeast. New York, Providence, Rhode Island. Hey, There's something to learn there. Like we need to figure out maybe and to take a look and see what's going on. Might be flight out of New York City, if anything,
Yeah.
flight out of the tri-state. But yeah, I think the Sun Belt definitely has been consistently there. So you can throw in everything from Florida to Arizona and Nevada. Midwest, Ohio, I've heard a lot of good things about Indianapolis. So that's also, I think they're states where there's good, like business friendly, low tax. I think Ohio might be higher tax, but yeah, there's some of these economic factors that promote economic job in migration and population migration. So key things to keep in mind when you think about where you're going to invest. Bio, anything to add?
No, it's just we look at this list all the time just to see where you can take advantage of the bigger market and you can see some secondary market, you know, that's also happening. So just don't focus on just the primary. Be like, okay, I'm only going to invest in Tampa. Buffalo might just be your next money-making location. Everybody, maybe people living. I know, like my friends in Canada, many of them like to work in Buffalo. So they actually come from Canada. They're able to drive to Toronto while they work in Buffalo. So I know many friends like that. I'm wondering if it's more larger geopolitical, like across country in this
Yep.
situation.
Yeah, I definitely say look at these kind of charts, understand what they mean, understand what the housing market means. Because when you see it plastered on a headline like this, they're usually talking about single family homes. They're actually not typically talking about multifamily whenever you just see housing market just like that. And so you got to keep that in mind. What is the single family housing market doing in a certain region, and how does that impact multifamily? And which one are you investing in? Are you investing in single families? Then yeah, that might be something that grabs your attention. But that's going to have downward pressure on multifamily if the single family housing is more hot, right? If it's too hot, then it's pricing people out, and that might be bullish for multifamily in that area. So you got to keep, like I said, there's always different vectors pulling one way or another. And so you just got to interpret it and then use that to make your investment decisions. I see a question, is work from home here to stay or will it change? So we can give our opinions for sure. I think to a large degree, it's not going to look like it did before COVID. At some level, there's going to be some work from home. Will it be as extensive as it was during COVID? Maybe not. But I think there's a lot of factors that say that it's going to be part of our culture going forward. I think that people have already moved. They've already transitioned to some of these high growth markets because they were allowed to work from home. So it's logistically challenging to get them back to the office, not only within the same city, but if they've already moved. A lot of people have moved out from the urban core into the suburbs. And so they may want that space. That might just be a cultural shift that's hard to try to reverse, especially after COVID. People just reassess what they value, space, some privacy. So I think to a lot of degree, it's gonna be part of our US landscape going forward. Bio, what do you think?
Yeah, I believe so too. I'm actually more positive than you on that. It's here to stay because when I look at almost every job, it's basically written there in some way. It's gonna be like some remote portion of it. And even when I look at the medical field, everything things that I never thought could be remote is being handled more remotely. There's an hospital close by me that is being run entirely by telemedicine. I don't even know how that's possible. The hospitalist is telemedicine. I see as a pulmonologist with tele, and everybody is tele. And the only physician there is the ER, whoever is in the ER. But the actual hospital is run by tele. It's sometimes
Hey,
scary, but it's what it is.
that's a phenomenal point. I think technology, we can say in general, is bullish for work from home, right? Because technology just allows you to be more efficient, right?
Yeah.
So as technology advances, as AI advances, you don't need the big footprint. And I think big employers are looking at that cost input. The office, commercial office spaces in a lot of stress right now They're like, look, we don't need to be paying all of this footprint when technology allows us to be more efficient from home. And that's what our employees want. And we want to stay competitive. So I don't need this huge office footprint. So
the topic of commercial property, I know we don't really invest in it as much. We do have some 6 warehouses, and I think you do medical offices, George. But medical offices, I think that one is difficult not to have a space,
right.
For medical offices. So if you're going to do an office like commercial, probably medical is probably your
Yeah.
best bet.
I think medical office is a different animal than just like the commercial office that we typically think of. Talking about, yep.
Hey, George, hey, Bayo, thanks for putting this together. So when we're talking about medical office space, you usually, most of the time, you have 1, 2, or 3 tenants that are on a long-term lease. When you're evaluating these properties for a potential acquisition, other than you knowing that they're on a long-term lease, they can probably afford their rent, is there any value to looking at the quality of the tenant that there is? What specialty are there? Their proximity to a big institution, a major population, because if those people are already in the building, some of that has been put into consideration before somebody sets up a practice in the place. But for you acquiring the building, what are the red flags that you will look for in terms of they have 7 years to go on their lease. They're already there, and they've been there 4 years. They don't look like they're going to not be there, but that lease is eventually going to come to an end. And are you going to be able to replace that same people? What about if they're not staying? Is the proximity of a bigger institution or nearby a positive or a negative to keeping that, or should you not even keep it for that long? You should be looking at a 5-year kind of deal where you get in and then you get up, because they're usually low maintenance from a landlord standpoint, correct?
I think it depends on if it's office, like clinics, versus surgery center, which is what I've invested in. That's actually very intensive operationally. And so if you're talking clinics, I think that's a lot more stable. Long-term leases, a product and a service sector that's going to always be in demand. I can't foresee it not being in demand. There may be stresses in it because those individual practices can get strained from the healthcare economics, right? Just as far as lowering reimbursements, you have to keep that in mind. The viability of the type of practice. Is it a solo practice, or are they shielded a little bit, like you said, by if they're associated with a hospital or a hospital system, or if they're a larger practice, multi-specialty. So you look at those things, the resilience of the individual practice itself in the face of these challenging healthcare economic landscape. I think that at the base, the need for healthcare is the same. It's the layer on top of it that makes it challenging that you have to assess. Is it primary care, which is, we know, is a challenge with as far as like being profitable. We saw a big macro signal a month ago, right? When Walmart shuttered all of its 51 primary care based offices, right? And they cited that because primary care just is not profitable. And so you have to look at that. Is it a subspecialty practice, right? Or is it a surgical practice? That's a little bit more resilient, right? Is it a group? You got 10 people, 20 people, or you got one person just trying to hold on? I think that all that factors in. But overall, medical is always going to be in demand. It's just, how does it look?
Yeah. Also ancillary services. So you can, when I try to make sure I can be like, oh, look at they can give you some of their finances. You can ask for it, absolutely, to see, these guys I want to be sure you guys are able to pay the rent for the next 5 years. And then you can, whatever version they give you, to be able to have an idea. Okay, they make a 30% profit margin. That's pretty good. So yes, you need to look at that. For primary care, like George said, you absolutely need ancillary services to survive, because you cannot see the volume. So you only can see 20 patients, or maybe 25, maybe 30. But for pulmonaries, for example, you can see 65 if you want to. I have partners that are seeing 25 people, 65 people a day by one person. And you be all level mostly. So you can see that's more likely to be viable than primary care was like seeing less patients. So I think, yeah, but I agree also that healthcare, I mean, I'm just saying that if you have to make a bet, at any office building right now, so that would be probably your best one, because you're going to have other companies, and then they move anytime. They move their headquarters, they shrink their sizes. They're like, oh yeah, we have 1,000 locations. Now we're shrinking to 200. I think either way with commercial, you're going to have issues. There's a couple of situations. Even if you want to get out very quickly, the sophisticated investors are also smart. So let's say you have a lease of 7 years, and then you think you can do 5 years and exit. But then the person that wants to buy it is going to look at it and be like, oh yeah, so all these leases are, are ending in 2 years, 1 year. So that's going to be a big problem for them in the next couple of years. So they probably will not buy it or want a discount for it. So either way, you're going to either have trouble filling it up after the 5 years is over, or it's going to be difficult for you to sell it. That's just my own thoughts on the office spaces.
Great question.
Thank you.
Yeah, I think the macro trends, we should, since we're a lot of us in healthcare, we need to talk about the macro of healthcare economics. And I think that was a great question to dive into that. All right, another topic, geopolitics. Thoughts on energy prices with geopolitical instability. I think this, go for it, but I'll let you.
Yesterday, right?
Yeah, we discussed this as we prepped for this call. We were like, what's energy and oil gonna do? So I'll let Bio start that one off. He's the oil man here.
Yeah, oil, as we all know, it's first of all, to start with, it's unstable, not unstable, high risk, high return, right? Which means the price of oil really affects your investment return. So it's more riskier than multifamily, but higher potential return, right? When it works. So that's just some people to know that already. So you know what percentage of your portfolio you want to put into oil and gas. I will not make it to be your base. Okay, your base should be multifamily or maybe a little bit of self-storages, but don't start to put majority of your investment into oil anyways. So we believe, based on the political climate, which is, we're also, as much as we were talking yesterday about how awesome it is to get our investments to be super profitable, right? So we also consumers too. So basically, it's going to affect you one way or the other, regardless. However, so we do believe that Republican, right? If Republican is in power, they focus more on energy sustainability, right? Energy independence. So energy independence means they want to flood the market more. So they want to lower the price of gas in general, so they will produce more and lower the price. So your investment in oil and gas actually will be low, your return. But the price of gas will be good. Everybody will be happy in the country. You will buying gas for $2. So it's just what it is. And then for Democrats, they focus on global warming and things like that. To them, so they're going to prevent more permits, right? No fracking law, which is interesting. So there will be less supply, and then would lead to higher gas prices across the country. But your investment is more likely to generate higher return, because if you close down half of the oil rigs, then the one that survives will be making a lot of profit. So that's my take on it.
Yeah, and then I'll go broader globally. I do think there's going to be more conflict going forward, just because the nature of our, not just US economy, but the world economy is just built on debt, and that debt is growing. And the only ways to really address that problem is either to print, and which I think they're going to do anyway, or the war is also very inflationary for oil. It has a huge impact. So I do think the geopolitical instability that we're seeing already is gonna continue to escalate. I think it's clear to me that outside of the US borders, people are trying to get more independent of the US dollar. And so this, I think, is going to lead to conflicts. It's going to lead to a competition for resources, including food and energy. And whenever there's conflict and war, the flow of oil stops. A lot of the oil goes into the actual conflict itself, whether that's building all the weapons and building all the infrastructure that you need to make war. Therefore, the oil prices, I do long term feel like they're going to go up. I do think they're going to go up with either president that gets elected. Is just to what degree. One's going to go up more than the other. But yeah, I do think that we're going to see higher prices in general for energy.
Yep, it's good to think broadly. So let's see, last one. Oh, one, as construction regulations changed or for the worse under this administration, or is it unchanged? I can take that first. I mean,
Sure.
based on personal opinion, I feel like either way, whether Republican or Democrat, they want housing for people. I actually see if you want it, I think you can get it. The constructions were coming on anyhow when the interest rate was down. And now people are just not asking for the permit. It's not that they're not trying to give you the permit. If you want to be, I believe that regardless, there's housing shortage overall. So if you have the resources and funding, yes, it might take you longer in some states to get the building done. But to actually start the construction, I'll probably say unchanged. And I don't think it's going to change either way. What do you think?
So I think there's almost two parts to this. It's what they're doing and what they want. Hard to really say what they want, but what they're doing is definitely making it more challenging to deliver affordable housing with all their regulations, with all their monetary policies. The costs of these to build is just higher. The banks have more strict rules about lending, whether it's good or bad. It's just the effect I'm pointing out. It's just more difficult to do business, and that's why I think you see a supply shortage of affordable housing. That's why less people buying homes. You see the trend, the macro trend of millennials and Gen Z. Did I say that right? Yes, Gen Z, who anticipate that they'll be able to buy a home. We even have a chart coming up, and we probably won't get to it, but it shows what millennials and Gen Z are spending on in place of actually saving for down payments for homes. They're actually going into debt, spending on experiences like travel and.
Put it to that slide. I think I like this slide.
Yeah. So they're taking out debt. They're not saving for homes if they're going into debt to go
just
to
to
the
eat food. Just to eat.
the finest dining, right? Live entertainment, right? Travel, right? So this, I think, is a reflection of regulations and laws and just how difficult it is to deliver affordable houses and for people to buy. So that's what my take is. I think it's gotten worse, and it's not related to the administration. So I don't play politics. I'm definitely not like a political guy. I think this happens whether it's a Republican or a Democrat in office. I think it's more of an economical thing where it's just these policies just impact ability for people to get affordable homes. And I think it'll get worse. I do think we're going to go to more and more of a renter nation, and that has an impact on how I invest. I want to invest in more multifamily because I do believe there's going to be more need, especially in the growth markets, for rental housing. It's just harder and harder to get a single family home.
I'm not sure what's going to happen with the Gen Z. Millennials, I think some are coming to the money, and we're going to get the money from the boomers soon.
Yeah,
there's going to be a transfer. It's going to happen, and I think we're going to get better. But I'm not sure about Gen Z. If they're already spending money just for pleasure, and they're basically taking this money out of credit cards. So there's no saving for homes. They're not going to catch up. I don't know how they are, unless they inherit houses. So I think the rent to own ratio is going to be super high. It's going to get higher over time.
Yep.
And this is just simple mathematics. So you can't say when you don't have money for dining and travel or anything, and you also take credit card instead of saving. So not only are you not saving for housing, you're also taking out debt.
Yep. Doubles a whammy. Yep. Thoughts on financial strength of banking system? I think there's a lot of instability in the banking system, especially for the smaller regional banks. They hold a lot of these commercial loans. They hold the majority of these commercial office loans on their balance sheets. And so those are obviously in trouble, and that debt is maturing. That's going to impact them significantly. They held a lot of bonds. They held a lot of bonds when interest rates were low. They got into a lot of bonds that got them into trouble as interest rates went higher. That also impacted their balance sheets, and you saw a lot of runs on the banks. I think the smaller banks, as you saw, will continue to see stress and fail, and they'll consolidate into the larger banks. That's my thought.
Yep. You can already see many of your local banks. What are they doing? I get email or messages all the time about deposit this money to our bank, we give you this interest rate. So they're trying to get more cash. And you've seen this a lot, giving you special rate. They're not doing that because they love you. They're doing it because they want to stabilize their balance sheet. And then if they can get more capital, then they can, stabilize. So I'm seeing it a lot here. Some will offer you 6%, put your money there for 2 years, put your money for 1 year. So open a new account with us. You get free this, free that, free everything if you move your business account to our bank. So I get that a lot.
Yep.
So to me, that just shows the stress that they are facing.
And now what do you do with this information, right? Now that I know that, or not know, now that I believe this is going to have an impact, how does it affect my ability to invest? Where am I going to invest? You can obviously invest directly in banks, but I also see this as opportunity, since this is like some volatility, right? There's also potential opportunity in private money markets. So you see private lenders. You can even start to grow like a list of colleagues that you can go out and make private loans, because you can play on the investment side as a debt asset, right? So you're seeing a lot of that. You've seen a lot of debt funds, privately owned debt funds. You see a lot of hedge funds getting into this space. And so that can impact how you invest. You can literally go out and put your money into a pool that is a debt fund, and they're taking the place of these failing banks with the traditional conventional loans. And now those debt funds become the new sources of capital, and they can make good fixed returns on that. That can help you grow your wealth.
Yeah, a lot of equity,
Equity fund.
Yeah, funds out there, private money lending, and you can get 14%, 15% from this. And usually it's also backed second lien or even first lien, depending on how you structure it or where you're coming in. If you're coming in as the bank, you can get first lien. So which means if the deal fails, you can take over the deal. So then you have to be ready for that too. So that's it. Just make sure the operators either have a partnership with people that can operate the property, or they themselves are able to do so. Because I'm seeing that a lot with operators raising debt funds, and they back it up with the property. But what happens if you actually acquire the property? So what now? You're gonna have to run the property now.
Right.
So
you gotta be ready.
You have to be ready.
This is the same thing that happened in 2008, and I'm sure it happened many times before, but the banks stopped lending, and all the discounts that were available in the assets like multifamily or single family homes, whole subdivisions, you could only get into them if you were able to raise capital. And usually that was from private lenders, private debt. And so those vehicles, people who are actual limited partners in those debt vehicles made a lot of money because there was money to be made. There were discounted deals. that wouldn't have happened if they weren't private. So it absolutely is a great question, and it can impact how you choose to invest your money today. Love it.
I guess we could do a second version because we still have a bunch of it maybe later in the year
Yep.
for the
Can do it.
rest.
Any questions, guys? Any thoughts on any other topics? Final thoughts? We're already 7 minutes past. We won't try to open up any new slides or charts. We'll just round up and finalize and answer any other burning questions.
While we're waiting for that, you guys have seen the real asset docs. So that's our new partnership, George and I, and we're using it for coaching program and also deals that we do together. So that's our combined name, Real Asset Docs.
Yep, we just went live this week, and we're hoping to help as many physicians, healthcare providers, high-income earners as we can. All right. In respect of everyone's time, we are going to sign off. We want to thank you guys again. We'll be on again in 2 weeks. We'll have another webinar for you guys. And until then, everyone have a good night and see you then.
Okay. Take care.
All right. Thanks a lot.
Thanks, Chris.
Thank you. Have a good night.